Canadian-controlled private corporations, CCPC, enjoy unique tax advantages, notably the Small Business Deduction, SBD, and the Lifetime Capital Gains Exemption, LCGE. Maximizing these benefits requires careful planning, particularly in how and when dividends are declared. This guide expands on the core considerations, strategies, and real-world approaches for balancing both objectives, maintaining SBD eligibility and preserving access to the LCGE. Core principles. The Small Business Deduction, SBD, provides CCPCs with a significantly reduced corporate tax rate, often around 12.2% in Ontario, on the first $500,000 of active business income. This is a critical advantage for smaller enterprises and is designed to encourage reinvestment and growth. The SBD applies only to active business income, not investment or passive income. Passive investment income above $50,000 per year, adjusted aggregate investment income or IE, starts to erode access to the SBD. For every dollar above $50,000, the 500,000 Solomon Islands dollars limit is reduced until it reaches zero at $150,000 of IE. Non-eligible dividends are paid out of after-tax income taxed at the small business rate. Declaring non-eligible dividends allows owners to extract profits while maintaining the SBD status of the corporation. These dividends are taxed at a slightly higher rate personally than eligible dividends, because the corporation paid tax at a lower rate, but they are crucial for ongoing SBD eligibility. Strategy: prioritize non-eligible dividends sourced from income taxed at the small business rate. Avoid accumulating excessive passive investment income, use dividends to distribute surplus retained earnings before they generate significant investment income. Monitor IE annually to ensure it stays below the $50,000 threshold. The Lifetime Capital Gains Exemption, LCGE, allows shareholders of a qualified small business corporation, QSBC, to shelter up to $1.25 million, effective June 25, 2024, indexed annually, of capital gains from taxation upon the sale of shares. The LCGE qualification requires that, at the time of sale, at least 90% of the corporation's assets, on a fair market value basis, must be used in an active business carried on primarily in Canada. For the 24 months immediately before the sale, more than 50% of the assets must have been used in an active business. The shareholder must have owned the shares for at least 24 months before the sale. Dividend strategy for LCGE. Minimize retained earnings that build up as passive or investment assets, cash, marketable securities, or non-operational real estate. Consider paying out dividends, most commonly non-eligible, but eligible if coming from GRIP, to clear excess cash or investments, keeping the corporation clean for the LCGE asset tests. Proactively monitor the balance sheet to ensure passive assets do not tip the scales beyond the LCGE thresholds. Types of dividends, when and why. Non-eligible dividends, paid from after-tax income that was taxed at the SBD rate. These are ideal for withdrawing profits up to the SBD limit and keeping the CCPC's passive income low. Eligible dividends, paid from income taxed at the general corporate rate, or from the general rate income pool, GRIP. These are taxed more favorably in the shareholder's hands, but if sourced from investment income or income taxed at the higher general rate, can threaten SBD status if not managed carefully. Therefore, to maintain SBD, use non-eligible dividends from active business income taxed at SBD rates. Preserve LCGE? Use dividends, either type, depending on the source, to reduce passive/investment assets and keep the corporation eligible as a QSBC. Pay out after general rate income? Use eligible dividends from GRIP, typically when income has already been taxed at the higher general rate. Integrated strategy, balancing both benefits. Regularly assess the level of passive investment income and assets. If approaching the SBD grind down limit or LCGE asset test limits, pay out sufficient dividends to reduce excess accumulations. Plan dividend payments in advance of a potential sale, 2 to 3 years out, as both SBD eligibility and the LCGE 24-month asset test are affected by prior year's balance sheets. Work with tax advisors to maintain compliance with both SBD and LCGE requirements. Tax laws and thresholds can change annually. Real-world example. Suppose your CCPC earns $400,000 annually from its active business and has accumulated $500,000 in retained earnings. Planning to sell within a few years, you want to maximize tax-free gains using the LCGE while preserving your SBD. The best approach: pay non-eligible dividends now to clear out excess retained earnings, reducing passive assets and ensuring compliance with the LCGE and SBD thresholds. Stay vigilant to keep annual passive investment income below $50,000 to avoid erosion of the SBD. As always, to preserve both the small business deduction and the lifetime capital gains exemption, use non-eligible dividends to withdraw active business income taxed at SBD rates and keep the corporation clean. Regularly pay out excess retained earnings that could otherwise become passive assets. Monitor both investment income and asset levels to avoid unintended loss of valuable tax benefits. Want to learn more? Book us online at www.taxmate.ca. Additional planning tools. Consider using a holding company or family trust to split income among family members, defer taxes on investment income, or enhance asset protection and succession planning. These advanced strategies should be tailored to your specific corporate and family circumstances with professional advice. Tax implications and potential red flags. While optimizing dividend strategies to preserve the small business deduction, SBD, and the lifetime capital gains exemption, LCGE, can unlock significant tax efficiencies, it is crucial to understand and respect the Canada Revenue Agency's (CRA) scrutiny in these areas. The CRA closely examines transactions and patterns that might be viewed as aggressive tax planning or attempts to inappropriately multiply tax benefits. Some key considerations and potential red flags include dividend sprinkling and income splitting. While it's possible to split income among family members, the CRA's tax on split income (TOSI) rules target unreasonable allocations of income to family members who do not meaningfully contribute to the business. Payments that are not commensurate with labor or capital provided may be challenged and taxed at the highest marginal rate. Maintaining active business status. The SBD is reserved for income from active business operations. Earning significant passive income or accumulating excessive passive assets within a CCPC can reduce or eliminate SBD eligibility. The CRA may view a corporation with disproportionate investment income or assets as drifting away from its active business purpose. Lifetime capital gains exemption eligibility. The LCGE is only available if, at the time of sale, at least 90% of the corporation's assets are used in an active business. Excessive retained earnings or passive investments may disqualify the company. The CRA may flag last-minute asset purification strategies intended solely to meet this test, especially if they lack true business purpose or substance. Related party transactions and purification timing. Asset transfers or purification just before a sale, especially those involving non-arm's length parties, may be scrutinized for avoidance. The CRA expects asset rebalancing to be part of an ongoing, bona fide business practice, not a one-off event. Artificial structures. Using family trusts or holding companies for asset protection or income splitting is accepted when genuine, but artificial or circular arrangements lacking commercial reality are likely to attract CRA attention. Best practices. To minimize audit risk and preserve valuable tax benefits, maintain clear documentation, ensure dividends and asset strategies are consistent with long-term business operations, and seek professional advice before implementing advanced planning. With prudent planning, CCPC owners can effectively balance tax efficiency and compliance, ensuring access to the SBD and LCGE while keeping the CRA on side. As always, balancing dividend declarations while protecting key tax benefits requires prudent planning, efficiency and compliance, ensuring access to the SBD and LCGE while keeping the CRA on side. Please subscribe to our channel and follow us on Facebook or Instagram. Thanks for watching.